necessarily the level, but the speed in which we've moved.
And the only reason I might say that, and again, Scott, I'm going to just say the future is uncertain. So, anything I say isn't anything with certainty in terms of outcomes. But if anyone said that the economy is going to have trouble with 1.5% interest rates or even 1.8, or that the thesis for owning Apple or Amazon or Facebook or tech broadly is threatened by a 1.5% 10-year yield, we know that it doesn't sort of stand the test of time. So I think at the moment, there is a general relationship. And I was actually, personally sort of wondering, should we maybe dial back the idea of being overweight FANG if rates are rising? But then as I think about sort of the structural arguments about why demand for tech products is still going to go up and why the U.S. economy is showing incredible resilience, and even the stock market's incredibly resilient. We had, huge debt default last week. I think these are reasons why investors need to look through this short-term pain, and I don't think it really changes the probabilities of a big rally into year-end.
But you would still overweight FANG?
Yes, I'd say that Epicenter remains, I think, the most likely leaders just because of the increase in rates, and I think we're getting a lot of cues from oil, and even the VIX is behaving. Rising rates takes a little bit away from tech, but I just think that there's an everything rally because investors got super cautious over the last 4 to 6 weeks. The rally last week didn't eliminate that upside potential, and strong markets stay strong. And I think as long as the economy is gaining momentum, which it looks like it is, I think you want to be overweight stocks.
Okay, Weiss. Obviously, I'm going to go to you to counter not only Farmer Jim, but Tom Lee. They're very sort of sane points. It's not like it's a ridiculous point of view. Tom Lee's not the only one saying it, nor is Farmer Jim. Marko Kolanovic, JP Morgan, use weakness to add to equities. We remain of the view that any weakness should be used to add to equities. So there is that view out there. And when people get overly negative on a day like this, there's a lot of eye rolling that says, oh, my God, chill out.
Yeah, well, keep in mind, just as I said, it's important. I'm not hysterical over today. Today's not what's driving my thinking. I've covered some of the shorts I came in with, but I'm still got some there, and I'm still balanced, still have cash. My view is not based just on rates. It's an amalgamation of events that I think remove the positive catalyst. And while the economy is moving ahead, we've actually lowered some GDP forecasts. So you can't say it's getting stronger. It's actually not getting stronger, number one. Number two, my thesis is based on third quarter. It's not based on today. It's not based on yesterday. I think the third quarter earnings reporting period is going to be disappointing. And we've seen some indications of that. Nike, FedEx, and we'll see others. So that's it. So I don't think you can have a roaring bull market when you have both rates going higher. And by the way, now Elizabeth Warren called Powell into question. I don't know how much that's going to help the market if he doesn't get renominated. So I think you've got numbers coming down. We've seen major multiple expansion that's driven the market up. Major multiple expansion.
Fair points.
That's not going to continue
Fair points.
In a raising rate environment.
May I come in?
Tom, no, hold on. I want Tom to respond to that because I think those are very good points, right? Higher rates, lower earnings. That doesn't put pressure on stocks, Tom?
Well, I think rates is a headline number. If the economy is expanding and strengthening and there's pent-up demand and shortages and that causes reflation and higher rates, that's obviously very good for earnings. It's good for return on invested capital, and it means higher interest rates, but that's exactly the environment from 1950 to 1970. So I think anybody who really studies markets would understand rising rates isn't an equity market killer. And if someone's saying, well, third quarter GDP numbers are going to get cut or earnings going to miss, so therefore stock markets are topping, that must mean there was 100 tops in the stock market just since 2010. I think what we have to keep in mind is, bull markets basically end when the economy itself is exhausting capital. So there aren't any strong returns to be earned. We're in an environment where there's supply chain glitches. It's causing delays and price increases. But that's not an environment that causes profit margins to collapse. Profit margins collapse when there's a demand problem or companies can't pass on price or investors overprice things. I mean, maybe someone can believe that, and I think Steve believes some of those pieces are in place, but to me, I don't think it's ever happened year one into an expansion. To me, this is just an early cycle situation.
Bull markets, forgive me, Tom, bull markets also end when the Fed changes its policy. And if you have a Fed chair who suggests that inflation, I mean, this is like a weekly thing now. Yes, it's hotter and it's probably lasts longer than we expected. If that becomes a problem, and I'm not even talking about the taper, I'm talking about things that the Fed may have to do into next year that even a Jamie Dimon, for example, throws out as a possibility. It's what Lee Cooperman calls a hostile Fed, right? He goes through this thing with bull markets end for a variety of reasons, but a hostile Fed, in his words, and that's what he is speaking about, could have an impact as well. What's also interesting is that energy is your favorite sector. So energy's moved a lot. Now, energy would have a less dramatic move or an impact, if you will, on the overall market because it's such a small part of the market. Right, Tom? But you think there's still room to run for energy stocks?
Yes, that's right.
But can I just add one thing before Tom answers? Tom, let me just inject one thing.
Well, if I said no, would it make a difference? Because it sounds like you're doing it anyway. Go ahead.
Not at this point, because I got going.
Go ahead. You're all revved up. Go ahead.
You and Jim both look for commodity stocks to continue to move. You can look for oil to continue to move. What happens to the increasing cost to add to oil as a feedstock, to aluminum, to steel? It's going to hurt margins. So it just doesn't evaporate into the air. Somebody's got to pay for it, and that causes inflation. So those sectors may do okay, but it's going to hurt the margins for the quarter.
Yeah.
Tom Lee.
Yeah. So there's a lot of things to cover, but just on Steve's point, do you guys remember when sugar prices went up in 2008 and it tripled and everyone said our food costs were going to go through the roof? And as you know, a box of cereal contains 25 cents worth of food, so it has almost no impact. We're overstating commodities. Commodities consumption in the U.S. is $900 billion for oil in the U.S. It's a $24 trillion economy. So oil can go up a lot, and it's not going to pinch wallets as much as people think. You need to get to $120 or more to actually even be comparable to $80 oil in 2008. But Scott, to your point about the Fed, you're dead right. If we have a policy error, we can have a fine economy and the stock market will react to that. So I do think there's risk. I mean, I hope Powell doesn't rage quit because he's being criticized again. I'm just kind of kidding on that. But I think the Fed's been understands the nuance and the importance of actually stable financial markets in the context of full employment inflation. So you're right, though. It's a huge risk. I mean, the Fed is still the most powerful entity in the world.
Well, I mean, Weiss is also right, though, about the idea of just rising costs. You look at cotton, for example. It's like up over $1 a pound today for the first time since 2011. So inflation cuts both ways, right? It has a hit on our wallet, and it also has a hit on corporate margins. And those companies who have pricing power can offset some of that. Those who don't have as much, in part to Weiss's point, are the ones whose earnings then are impacted, thus their stocks are impacted, thus our overall view of what was a margin expansion world becomes a little more difficult to get gains. Tom, you're going to join us on Friday, but I had to have you on today. I had to hear your voice on what you thought about all this, so I'll tease that. We'll see you on Friday. Thank you so much for coming on with us, okay? That's Tom Lee of Fundstrat. All right. Up next, a lot of headlines coming out of Fed Chair Powell today. The Treasury Secretary is there as well in the testimony on Capitol Hill. We're going to go to a break. We'll check on the major averages. There you go. The Dow's down 523. NASDAQ's down 375. The yield on the 10 years at 152. We're back in 2.